Ladies and gentlemen, welcome to another episode of the Resource Insider podcast. And it has been a couple of months, I think, since we last recorded an episode. And it's not because I haven't wanted to do it, but it's because we've actually been so busy in this bull market that we've been experiencing. And at Resource Insider, we've been doing deals. We've been engaging with our subscribers, and I've spent almost all of my time out hunting for new opportunities. And it's been highly lucrative for myself and our members, and we've been very happy how the last few months have gone. And for those of you who are watching this on video as opposed to listening to the audio version of this podcast, you can probably see I'm not in my normal office or at my house. I'm actually up at Whistler this week, and I came up here to have a vacation. It's supposed to be a week of hiking and dinners and good time. But then another deal came across our desk that we ended up having to do. So I've been sitting at this desk all week and working our way through that. And it's just been such, exciting times in the market, and I haven't been able to pull myself away. And, mining is so cyclical. It's strike while the iron is hot. And that's what we've been focused on. However, I wanted to take some time away from this and get back to doing this podcast in particular, because I think it's going to be, and I want to hear your feedback on this, but I think it will be one of the most valuable podcasts our listeners are ever going to hear. It's going to be extremely valuable for those of you who are at home investing in junior mining and exploration companies. And it's also going to be valuable for CEOs that are running these companies and are maybe not from a technical background. Maybe they have a finance background, for example. So we have had a lot of guests on this show. We've had Frank Justra and Ross Beatty and Marco Day, brilliant entrepreneurs. But I'm going to say there are probably few things we've discussed that are going to be able to help you as an investor better allocate capital into this sector. And I'm kind of giving away a bit of my secret sauce here today, because at Resource Insider, we don't exist in a vacuum. I heavily rely on other experts in the space when we're making our investment decisions. We operate very similar to a private equity firm or hedge fund or another professional investor, insofar that we use teams of very experienced people. And my guest today is a longtime friend and one of these people that I have relied really heavily on, particularly when evaluating exploration in junior projects, particularly gold in greenstone belts, which is his specialty. But there's almost not been a Resource Insider deal that I have not run by him, and he's invested in many of them with his own money. So we're going to get into today his background, why I rely so heavily on him, and what he's doing with his own company. And so his name is Francis MacDonald. He is the Executive Vice President of Kenorland Minerals. And I think without further ado, it's time to introduce him. So Francis, welcome to the show today.
Good to be here, Jamie. Thanks for having me.
So what I was thinking about, we've been talking about recording this episode for a few months now, and we're going to title this episode "The Science of Discovery." We're going to talk about what I would consider a more quantitative approach to exploration and understanding discovery, and we'll get into that in a minute. But I was trying to remember, how long have we known each other and been working together now? It's been about 5 years, I think.
Yeah, I think it's been about 5 years. I think the first time we met each other was in a CD bar in Vancouver at some mining drinks thing, and a good place to meet new people.
Yeah, and you just come off working for Newmont in Ethiopia, is that right?
Yeah, that's right. I was working for Newmont in Ethiopia, and then before that in West Africa, and before that at the Hope Bay project in Nunavut.
So I think, that was a very interesting time in your life, because it was shortly after that you launched Kenorland with Zach Flood, who's still the CEO of the company, and your partner there. Can you give us a bit of an overview of what Kenorland is and the thesis that started that company?
Yeah, sure. So Kenorland started in 2016, and there's four founders in the company: Zach Flood, who you mentioned, and Scott Smits and Dave Stevenson as well. And so we had all worked together at the Hope Bay project in 2007, and we had kind of gone through a couple renditions of companies before this as well. And in 2016, the gold price took that bump from about 1050 to $1,300, and it seemed like, okay, this is probably the bottom. And so we came together, started putting together some gold ideas or gold exploration ideas, and went to John Tognetti at Haywood Securities, and he gave us the seed funding to get this company started. And so we it took us a while to kind of get into the project generator model, which is where we settled for the first while. And so what our kind of goal was to go out and look for big scale greenfields projects and really go after the greenfield space, because we all felt that that was being underfunded relative to brownfields and more advanced targets.
Okay, so you basically had a few $100,000 of other people's money in your pockets. You were four guys at the time working out of your respective apartments. And now, in the coming weeks or months, you guys are on the track to list as a public company after about 5 years, partnerships with some of the biggest mining companies in the world, what could potentially end up being a very major discovery under your belt. And a lot of other things that we're going to talk about here. So let's start our conversation today by talking about what Kenorlands methodology is and how it's led to what you've been calling this discovery model.
Sure. So Kenorland's methodology, I think it comes from the places that we've worked at before. So my background is with Newmont, and same with Scott Smits, and Zach was with the Ivanhoe Group. And so these are companies that take a really big scale approach to exploration. And the Ivanhoe Group has done exploration all over the world and screened a huge amount of ground, and same with Newmont as well. And so we've kind of taken these skill sets that we've learned from these companies, and we're trying to apply it to our own company. And I think the biggest key to the success of those companies is the scale that you think of. And in terms of greenfields exploration, I think you really have to look at the big picture first. And it's really all about initial land selection and screening a huge amount of ground, because you can have a geologic model and you can think that something's somewhere, but there's always going to be surprises. And if you don't have the land and you haven't screened enough of it in the first place, then you're kind of shooting yourself in the foot, really.
So is
So
starting with these massive land packages, does that differ from what you see the average exploration company doing?
yeah, I think so. And so I think the initial size of land package that we started with on all of our projects was about 50,000 hectares or 500 square kilometers. And in some parts of the world, that's small. Like when you go to West Africa, the land packages are large. They're 1,000 to 2,000 square kilometers. But in Canada, I would say the typical size of a land package is, kind of maybe 5,000 to 10,000 hectares, or 500 square kilometers to 1,000 square kilometers. And so there's always these kind of rules of thumb that you hear about, that one project within 1,000 makes a mine. And so I think there's kind of a bit of a falsehood in there. It should really be how much land that you've explored. And if you take 1,000 projects that are, let's say 1,000 hectares, that gives you 1,000,000 hectares of ground. And so if you want to be successful, then go out and screen 1,000,000 hectares of ground, and statistically you'll find a deposit, basically.
So I guess the question is, how do you screen that ground, quickly, efficiently, and cost effectively, so that when you do find this deposit, it's worth your time and it creates value for shareholders?
Yeah, so I mean, I think it depends on the commodities that you're looking for in part. And so we've kind of focused on gold because Canada has amazing gold potential. The Abitibi Greenstone Belt has an endowment of about 225 million ounces of gold. It's the second largest gold producing district in the world, and so and my background and Scott's background is in gold, and so we started out looking for gold because Canada is a good place to look for gold. And so, in my mind, if you're looking for gold, the primary exploration technique is geochemistry. And gold, a lot of the time, doesn't necessarily have a specific geophysical signature. So, geochemistry is really the main tool. And you really need to have some kind of sample that has gold in it. That's the first pass thing. And so that's kind of how we've gone out and designed these programs is we do these massive geochemical programs and see what comes out of it. And then, it's really just a rate and rank exercise of screening enough ground with geochemistry, follow up on the anomalies, and eventually you find something.
So before we get into the details of this and go through the presentation you've got ready, can you kind of give us the highlights of Kenorland's successes to date?
Sure. So we've been in operation for 4 years. We started as a private company in 2016, and like you said, we started out with about 350,000 of somebody else's money, and from that we've raised about 3 million in private placements in a private company over 4 years. We've leveraged that to put 15 million in the ground through partner spend. We've brought in 3 million in cash payments and management fees because we operate the programs for our partners. So Kenorland is effectively break even after 4 years in operation with a huge portfolio. And so we've screened after a program we're doing right now, it'll be about 260,000 hectares of ground with geochemistry. And that's led to this discovery that we've made in Quebec at our Renault target in the Frotet project, where we put out some drill results a couple of weeks ago. That it was 29 meters at 8.5 grams on the first initial drill program. And so we've kind of decided that now is a good time to take Kenorland public. So we're pursuing an RTO transaction with Northway Resources, which is a company that we started to go after a specific project. And so it's we've been in operation for 4 years. We've been doing a ton of exploration with major partners like Sumitomo and Freeport McMoran and Newmont. And so it's we figured that this is a really good time in the market, and it's time to open the kimono and kind of show people what we've been up to for the last 4 years.
Okay. So you've been working with these major partners. You were a major shareholder in another company that you helped start, Northway Minerals. Zach Flood, the CEO of Kenorland, was also running this. You're going to combine those assets, do a financing, and Kenorland's going to be a public company after that. And you're going to continue. Are you going to continue this style of work of building partnerships and doing joint ventures with major companies? Are you going to start drilling these assets yourself? Does that change the reality for Kenorland or the strategy?
Yeah, it absolutely changes it. And the reason why we weren't going out and taking these shots ourselves was because it was a bad time in the market. We were a private company, and so we were raising money at a $7 or $8 million valuation. And so to go out and drill a target ourselves to the sufficiency that it should have on a first pass program, we would take something like 40 or 50% dilution. And so
Mm-hmm.
at that point, it didn't make sense to do that. But I think now we can raise money at a high enough valuation that we're going to go out and start taking shots ourselves. And so it's really going to be a hybrid model where we have these big joint ventures on the go, and we've got 3 that are operating now, and we've got 3 projects that we're going to look to advance ourselves, and one specifically in Alaska, the Healy project, which we're going to go out and put kind of 3,000 to 5,000 meters of drilling into ourselves next year.
Okay. And I guess I should have started this conversation by saying that I'm also a shareholder in Kenorland, and I was one of the early shareholders several years ago. And so I'm pretty excited about this RTO that you guys have coming up. And I'm excited to see a lot more of that, I guess, intellectual capital being kind of remaining in the company and getting the full value for that, which is, of course, there's the upside and the downside of the joint venture model, right? Is somebody else pays for it, but somebody else also gets the majority of the upside. So I'm excited to see,
Sure.
after you've proven the effectiveness of what you guys are doing, now more of that remain as 100% ownership of Kenorland.
Yeah, and I think, some people love the project generator model, some people hate it. And, so now we're kind of going to be bridging both sides of it where,
Hmm.
we've already had these deals signed with major partners. And, honestly, if we went back and we could, do it ourselves now after this kind of huge increase in the gold price and the success that we've had on our Frotep project, we might look at doing that ourselves. But that's where we're at, and it's really nice to have a big partner that can really take on significant exploration and put a lot of money in the ground really quickly.
Okay, so I think it's time that we really get into the weeds here and start talking about what you guys have learned over the last 4 years doing this, and it's really the discovery model that you've put together. So I think you've got a presentation that you want to share with us now.
Yeah, that's I'll bring that up here. So we've called this the
So Francis, I can't see a shared screen yet.
oh, okay. Let's share screen, that will help.
There we go.
Okay.
Perfect. Okay.
So we've kind of called this the discovery study, and the way this came about was there's two reasons. One is that Newmont kind of looks at metrics like this for their internal kind of rate and rank, and then we were thinking about these metrics for the Healy project in Northway Resources, and asking ourselves the questions, what kind of drill intersects should we see on the first program? How many meters should we drill? When do we walk away from this project? When do we keep going? And so that really kind of spawned this study is because I don't think we really had a good feel for it internally of what we should be looking for. And I think as an exploration company, that's kind of fundamental. You should really know what you're looking for. And so we really went into the weeds, like you said, and really got into it and started looking at all of the more than 2 million ounce deposits in Canada and seeing what they look like in the early or initial drilling. And so in terms of disclosure, forward-looking statements, there's going to be some forward-looking statements. And then also as another kind of disclaimer, this data has been compiled from a number of different sources, and we don't guarantee the accuracy of it or the completeness of it. So it's from wherever we could get it from, and kind of use it at your own risk, basically. So I think to start out, a good thing to do is look at the locations of these more than 2 million ounce deposits in Canada. And so when you add up all of the resources and the historic production from these gold deposits, there are 83 deposits in Canada that have more than 2 million ounces of gold. And so these are excluding copper dominant porphyry systems or other deposit types where gold isn't the primary commodity. And so
So,
adding up,
if I might ask, why 2 million ounces? Why was that the size that you chose as your sort of benchmark cutoff?
uh, that's a good question. It's kind of nominal. I mean, you could bump it up probably. I think looking at 1 million ounce deposits, I don't think a 1 million ounce deposit is necessarily going to excite many people or be mineable in terms of economic
Yeah.
terms. 2 million ounce deposit, possibly. Once you have 2 million ounces, lots of people have started mining at that point, and then eventually you find more and more as you go. And you could do this at any nominal cutoff, basically. But I thought 2 million was a good thing to look at.
So this was the size where it really gets worth going after, really.
Yeah, I think people in the right jurisdiction would be excited about a 2 million ounce deposit.
Okay.
So when you add up all of those ounces and all of these greater than 2 million ounce deposits, that gives Canada a total endowment of about 654 million ounces. And so that's current resources, but also historic production as well. And when we look at these in terms of districts, I think this is really important to look at. And so there are 6 geological domains in Canada that hold 87% of that endowment of the 654 million ounces. And so 75% of that endowment is in Archean greenstone belts. And so for non-geologists out there, these are volcanic and sedimentary rocks that formed at about 2.7 billion years ago. And these are some of the most prospective rocks for gold deposits on the planet. And then another notable district is the Golden Triangle, which has about 118 million ounces of gold, and that's about 18% of the total endowment. And so in terms of, where do you want to be? I think as an exploration company, it's probably good to stick in these known districts. And obviously there are some areas where there's no known deposits and you can go out and make a significant discovery. And I think the Eleanor deposit is a really good example of that. But in general, for kind of lowering your risk, it's better to stay in these known districts because there are certain geologic criteria that are causing the gold to form in these districts.
Hmm. Yeah, I mean, by looking at this, it's almost not worth your time focusing on anything besides the Southern Abitibi and the Golden Triangle.
Uh, I mean, there's a lot of gold in those places, and I wouldn't say that. So like I said,
Am
Eleanor
I
is a
am
really
I
good
going to piss
example.
off a lot of geologists by saying that? Is
Probably,
that...
yeah,
Sorry.
probably, yeah. I mean, it's kind of you look at it in terms of risk and like I think the lower risk areas are obviously the places that have a lot of historic known endowment. And this
Mm-hmm.
is the way that we kind of look at things in Kenorland is like, let's stick in these districts that have a lot of endowment and let's just use different exploration methods and look in places where people haven't looked before around these big well-endowed districts.
Okay.
And so with these 80 or so deposits, I've broken these out into 3 different classes, and this is how they've been discovered. And so that would be greenfields, brownfields, and historic. And greenfields, as a definition, these are deposits that were discovered in an area where there's no significant gold deposits found before. And so an example of that, again, would be the Eleanor deposit in James Bay. Brownfield deposits are deposits that were discovered around already known significant gold deposits. And so there
Mm-hmm.
would be some, say, like the LaRonde deposit in the southern Abitibi in Quebec, that was discovered in a really well-known and endowed area before.
Would you consider Great Bear to fall into that category?
Um, Great Bear, no, I wouldn't. And the reason is because there wasn't a historic resource there. I
Hmm.
don't think. And
So
there
it's
was,
in that well-known Red Lake district, but it didn't have the resource, or it wasn't in close enough proximity to another mine for it to really fall into the brownfields category.
yeah, exactly. I mean, I think it's probably 20 or 30 kilometers from Red
Hmm.
Lake, or maybe even more. Um, so no, I don't think I would call that, I wouldn't call that brownfields.
Okay, so that would fit the greenfields definition then.
Yeah, that would be the greenfields definition. And then the last one is a historic. And so these would be deposits that were found by prospecting and in the early days of Canada, in the frontier days. So 1910, 1920, 1930. And that's when deposits like Red Lake were discovered, and Kerr Addison and Hollinger McIntyre in the Timmins camp. And so when you look at these 3 classifications and look at the total number of deposits by class and the total number of ounces by class, it kind of breaks down into roughly 1/3 for each. And Greenfields has been responsible for slightly more than the historic or brownfield deposits as well.
Hmm. Now, we talked about this earlier, but this is not necessarily representative of the cost of finding these deposits, right? Like the cost of finding 1 million or 2 million ounces of green fields might not be the same, or likely isn't the same as the cost of identifying a new 2 million ounces in a historic deposit. Correct?
Yeah, exactly. So if you really wanted to look at it, you would have to look at the total number of dollars spent in terms of these classes and
Hmm.
look at the total return on investment. But that'll be a study for another time, I think.
All right. Podcast number 2.
But yeah. And so this is a slide where we look at when these deposits were discovered by the greenfields, brownfields, and historic classes. And so all of the historic deposits were kind of pre-1950s, and those were really the prospecting deposits where someone went up to an outcrop, found a quartz vein, there was just tons of gold in it, and they basically started sinking a shaft into it already. And so in the 1950s, these types of deposits were being depleted, and people had to start using new methods. And so after the 50s and in the 60s, this is when airborne geophysics started being flown. And so in the 60s, 70s, and 80s, there was a ton of airborne geophysics flown, and deposits were found using those methodologies. In the 1980s, you see this huge jump in discoveries of greenfields and brownfields types. And I think that's due to flow through financing when that was introduced.
Can you explain what flow through financing is? Because a lot of our viewers are not Canadian.
So flow through is a tax benefit that the Canadian government brought in the 1980s, and the basic of it is when an investor puts money into a flow through financing, that's tax deductible, and so you can effectively decrease your taxable income. So for people that are looking to take themselves out of a certain tax bracket into a lower tax bracket, it's a really attractive investment tool.
But yeah, but this graph is just so good to show that, like, obviously more money was spent on exploration at that time, and then it's just a nice clear demonstrator of the more dollars spent, the more things found, right? And I mean that seems obvious, but it is nice to have that shown so starkly.
Yeah, exactly. And in the 80s, as you can see here, the number of discoveries of significant gold deposits, it's going down every decade. And so from 1980 to 2000, there was 22 grassroots discoveries in Canada. And so, examples of this would be the Hemlo deposit, which was a 20 million ounce deposit discovered in 1981. And then from 2000 to 2020, there were only 5 grassroots discoveries made. And so, as we're going in time, the number of grassroots discoveries is going down. And so why is this is a question. And so my take on it is that grassroots exploration has been underfunded relative to brownfields exploration.
Okay.
So we're going to start talking about discovery, which is really the point of this study. And discovery is a word that's thrown around a lot. And so we can look at it qualitatively or we can look at it quantitatively. And so discovery is really one of the largest value addition periods during the cycle of a mining project. And this graph is something that people have probably seen before. This is the Lassonde curve that Pierre Lassonde came up with, I think, in the 80s. And so it's really the life of an exploration project. And it starts with a concept. So you have geologists saying, okay, I think we should go out to this part of the world or this part of Canada, and we should look here. And so, that takes a little bit of time to get the financing and get the people together and acquire the land and permits and all that kind of thing. And so usually that culminates in initial exploration programs, and that takes generally 1 to 2 years. And so the successful outcome of an initial exploration program is usually a drill program that has significant drill intersects on the first program. And so I think we've seen this in the last kind of 2 years or so, where there's been an exploration company that's got a $10 to $20 million market cap. They put out some incredible drill results on a first pass program, and overnight it's a $100 to $150 million market cap company. So there's an incredible amount of value that's added on these initial exploration programs.
Yeah, and that's what so many resource investors are looking for, right? These, like, the quote unquote 10 bagger, which you almost, I mean, that is largely driven by discovery.
Exactly. That's it. And so, so it's driven by discovery, but then, so how do we quantify this and recognize it as it's happening? And so, like we were saying,
and how do investors at home select them, right? Because it's all good and well to hear some promoter stand up on a podium somewhere and tell you he's got the best thing in the world. But I would say almost no investors know what a discovery actually looks like from a geological perspective. And I would even say few people operating in this sector know that either.
exactly. And honestly, before I did this study, I was one of those people that didn't really recognize it either. And so, I think people that have been involved in a discovery obviously know that discovery story really well. But, I don't think there's many people that have been involved in the whole breadth of discoveries in Canada. So that's something, that's why we went and did this, is to look at that and kind of take a really big picture look at discovery and see what it actually looks like. And
All right,
so
Francis, tell us how to make millions of dollars now making discoveries.
that I'll keep that secret to myself, but so to recognize a discovery, I think you really have to look at the drilling. And because that's really where a lot of the times a discovery is defined, is on the initial drilling. And so as a definition, a discovery hole is the best drill hole on the initial drill program into the eventual mineral deposit. So what we did was we did a huge amount of data compilation over all of these 83 gold deposits that are over 2 million ounces, and went through an incredible amount of reports and press releases and any kind of data source we could find to compile the initial drilling out of all of these deposits. And so some of them, there's a number of them that we couldn't find anything, so they're not included here. But if you dig deep enough and long enough, you can actually find the initial drilling into these deposits. And so as a definition, I think one of the things that we're going to talk about a lot in the rest of this presentation is this concept of GT, which is grade times thickness of a drill hole intersect. And so as an example to explain this, the grade would be 10 grams per ton. The thickness is 10 meters. And so that's 100 GT hole because it's 10 meters times 10 grams. And so
if we can just define thickness a little more thoroughly. So does that mean, like, it's not the length of the entire drill hole for people that are at home wondering about that. It's the portion of that drill hole that mineralization occurs over, right?
Yeah, exactly. So when people report drill intersects, it would be 5 meters at 10 grams per ton. So it will be that 5 meters that has gold in it.
Mm-hmm. Okay.
So this is a graph of all of the GT intersects into these deposits that we could find. And so there's a wide variety of these, and we'll talk about some of the variables that influence these. But on the high side, you have deposits like Brucejack, where they put out those insane drill results of like 1.5 meters at 25,000 grams per ton, and so that's off the charts. And just as a few other examples, Eleanor was about a 300 GT hole on the first program. Cote Lake was about 220 GT. But then on the low side, you have some really kind of surprising ones as well. So Musselwhite is in northern Ontario, and I think it's a 5 or 6 million ounce deposit. And the best GT hole on the program was a 50 GT intersect. So it's a wide variety. There's a lot of ways, a lot of factors that influence this. But when you look at it statistically, the median out of all of these deposits is 134 GT hole. And if you want to capture 80% of these deposits, it's a 75 GT hole.
Okay.
So when we just look at grassroots or greenfields discoveries, these numbers change a little bit and they go down a little bit. And so if you want to pick up 80% of the greenfields discoveries, there should be a 62 GT hole on the initial program. And the median of all the greenfields discoveries is 115 GT hole.
Okay. So the significance of this, if we sort of break this down, is that when an exploration's starting and you were, at home reading drill releases or press releases rather of drill results, investors should be looking at, okay, what is the grade and over what meterage is it? And if they want to see something, if they're looking at something and they want to invest because they're looking to invest in the potential for a discovery, they want to be seeing something that's 115 GTs, right? So something like 10 grams per ton over 11 and a half meters, for example. If they start to see these
Yeah.
things, then it's something that they should really be paying attention to. Am I interpreting that right?
Exactly. Yeah. And so obviously these are rules of thumb, and there are outliers and there's a number of
Mm-hmm.
deposits that don't meet these criteria, but I think you have to look at this if in the positive case. So if somebody does hit 10 meters at 11 grams per ton or 11 and a half grams per ton, then that's something that could be really significant. And that's the kind of drill intersect that a lot of these greater than 2 million ounce deposits have produced on initial programs.
Okay. All right.
So one question that would obviously come out of this is, does the GT intersect on the first program have any correlation to the size of the eventual deposit? And this is on a log scale of GT on the y-axis and total gold endowment on the x-axis. And so it's kind of a big scatter. But if you really break it down, the majority of 2 million ounce deposits have initial GT intersects of greater than 50 GT. And the majority of greater than 5 million ounce deposits have initial GT intersects of greater than 134, which was the median that we saw in the last slides. So again, rule of thumb, but when we're building this model off of the Canadian greater than 2 million ounce deposits, and when we look at majorities, these are the kind of numbers that we see.
Mm-hmm. Okay.
And then another interesting thing to look at is the intersect thickness of those initial holes. And like we were talking about before, so this is the thickness of the interval that has gold in it. And so in modern gold deposits, the tonnage is one of the big factors of how much gold is there. And so the tonnage is kind of proportionate to the volume, which is kind of proportionate to the gold endowment in the end. And so grade, varies between, let's say, 1 and 10 grams per ton. So it's kind of only one order of magnitude, but the tonnage can really change from, it could change from 1 million tons to 200 million tons. And so tonnage is really one of the big factors that you need to look for.
So when I think about this, Francis, I think kind of the key takeaway here is that the thickness does matter a lot, right? So we're talking about finding these 135 GTs, but having 135 grams per ton over 1 meter is not the same thing as having 13.5 grams per ton over 10 meters, right? In terms of the likelihood of there being a real major deposit there. Am I interpreting that correctly?
Yeah, That's right. And so, if say on initial drill program you hit 1 meter of 135 grams per ton, that's probably hosted in a quartz vein, and the quartz veins can die out, they can get thinner in places, and so it's really hard to build tonnage in narrow high grade veins.
Right.
So it's a lot of the time they don't bulk out to be anything really
Hmm.
significant.
And
So
so
what you
this
really
comes
want,
down to both the mineability and the scale, right? Like it's got to be something that's big enough to be worth mining, right? And not just
yeah,
these small little intercepts. Okay.
exactly, yeah. And so on an initial drill program, so the tonnage is kind of proportionate to the volume. So the only dimension that we get out of an initial drill hole is thickness of the ore body. And
Hmm.
so, we don't get the strike extent, we don't get the depth extent, but we do get the thickness. And so if we just look at that thickness and look at the GT intersects relative to that thickness, I think there's a really interesting metric that comes out of that. So the majority of greater than 2 million ounce deposits have discovery intersects that are greater than 5 meters of mineralized rock. And then the majority of 5 or greater than 5 million ounce deposits have intersects that are greater than 10 meters of mineralized rock. So I think this is an incredibly powerful metric to use and to think about. And it helps you filter out a lot of the kind of small tonnage, high grade deposits that really won't ever bulk out to anything.
Hmm. No, I think that's really interesting to point out. I mean, just yesterday I was reading a press release where they press released I can't remember what it was, 10 or 15 gram per tons, but it was over zero point 0.4 meters in a drill hole. And you see those really small intercepts, and I mean, you're the geologist, but for me, it's pretty hard to get excited over something like that.
Yeah, you have to put it in context. Like there are places, I've seen pictures of the CB mine in Saskatchewan where the vein goes from something like 50 centimeters at surface, and then at depth it blows out to, kind of 20 meters wide. And so,
Hmm.
obviously all of these things have to be taken in context, and there's, you have to look at the geologic environment it's in and all of this kind of thing. But yeah, as say you're an investor and looking at this thing, I don't think I would get too excited about 50 centimeters of 10 or 15 grams, really.
Yeah. Yeah. And I guess we're talking about sort of general metrics people can use, right? And that need to look
Yeah,
at who maybe don't have that, that they're not geologists. They don't have the scientific background to really interpret that beyond these things. So,
yeah,
okay, good.
exactly. Yeah. So one thing that people might ask as well is the amount of drilling that goes into these initial programs. And so I think that's a really important factor to look at. And so this is the number of meters that have gone into all of these initial drill programs. And so the median out of all these programs is about 4,200 meters. And so I think that's also something to keep in mind as well, is if a company goes out and tests a target with less than 4,000 meters of drilling, it's really not that much drilling. And in terms of looking at all of these discoveries, that's the median. And so I think as we go on in time as well, the discoveries are going to take more and more drilling. So that's kind of a rule of thumb, is look for your junior explorer to be putting something like 4,000 meters into the ground if they're really going to give it a chance. And
And why
so,
do you think we're going to be seeing more drilling? Is that just because over time the low hanging fruit gets plucked and it just becomes more work to find those deposits?
yeah, that's exactly it. And I think, Richard Shoddy is Minex Consulting in Australia, and he always has some really good figures of showing the depth of cover as we go in time, and it keeps getting deeper and deeper. And in Canada, a lot of these discoveries were made by drilling under an outcrop. And, I think most of those discoveries are the low-hanging fruit and they've been picked. And so, it's really going to take more drilling to kind of shake out new deposits, I think.
Well, we've discussed this before, sort of the difference in discovery, I don't know what you call it, strategy in a place like Canada versus somewhere like Australia, where Canada has that history of having this outcropping rock that geologists have been able to walk up to and hit with a hammer and take a sample home. And whilst Australia has more of a history of exploring undercover. Can you elaborate on that anymore?
Yeah, sure. So, um, I think in general, this is my personal opinion, and I'm Canadian as well, so I'm taking a dig at myself a little bit. But I think in Canada, we tend to focus on outcrops and looking at outcrops because we have a lot of rock to look at, and we spend a lot of time trying to understand those outcrops to to help us find a deposit. And so, sometimes that's a good way to do it, but sometimes it can be a distraction as well. And I
Mm.
think in Australia, where they don't have a lot of outcrop, they've had to be a bit more innovative and use more geologic thinking and kind of do more systematic geochemistry a lot of the time. And so, the nature of exploration is in Australia is completely different. And I think in Canada, we have to get away from that, and we really have to start looking undercover and stop focusing on mineral occurrences or outcropping mineral occurrences that have been found in the 50s, 60s, 70s, 80s, and let's go out and look for something new.
Okay. And so that's where obviously meters drilled starts to make a big difference.
Yeah, exactly. And so I think one important thing here to talk about is if a company goes out and drills less than 4,000 meters, so and they hit, say, something like a 70 GT intersect on that program, that could be really significant. And then if a company goes out and drills 10,000 meters on an initial program and they don't produce something like 100 GT intersect, and they've tested all of the plausible geologic targets, then I think that property or area should really be downgraded.
Yeah, well, this is one of the really hard things for any exploration team, right? Any exploration company is to know when to walk away from an asset. Um,
Yeah, well, I think David Lowell had a quote about, mineral exploration is really just about balancing risk. And, I think as explorationists or exploration geologists, that's really our job is to balance that risk. And so, you have to know when to keep going and you have to know when to walk away because there's only a certain amount of capital available to what we're doing. And the better that you can make those decisions, the more effectively that you can kind of allocate that capital that's available to you.
And so, for investors listening at home, when they're maybe invested in a company and they see that more than 10,000 meters have been drilled and they're not hitting this 100 GT or higher, that's time, unless there are some, context to that we're not, talking about now. It's time to start thinking about, okay, maybe this asset doesn't have the potential to be what we'd hoped it would be.
Yeah, and so I think at that point you have to look at if you're investing in the company because of the asset or because of the team. And if it's because of the team and they make the right decisions and they make the call to say, okay, we've tested this, I think it's time to walk away, then I think that's an appropriate decision to make, and maybe as an investor you stay with it. But if it's at the asset
Mhm.
level, might be time to look at other assets at that point.
So as an investor, I'll weigh on this. I would be willing to stick with that team if they had other projects in the wing that they were able to refocus on that I thought had sort of equal or greater potential as maybe their primary asset. And I think that's why, smart exploration teams typically have more than one asset early on in their genesis until they sort of get that initial hit and say, okay, look, it's time to focus our resources on developing this out. Um, and that's just my personal opinion on this.
Yeah, and I think you really have to do that as an exploration company is because we're exploring these things to kill them or to move them forward, and it's pretty easy to kill a project. So if you don't have something else to fall back on, it might be problematic for you.
All right, let's move
Yeah.
on.
Okay. So this is kind of taking that concept and looking at the meters drilled versus the GT intersects that came out of those programs. And so this is on a log plot, and there's a rough kind of linear correlation between those. And so that means, the more meters that you drill on the initial program, the better chance you have of intersecting a significant intersect. And I think this is interesting because companies can kind of plot their data on this and see where they fall. And obviously there are some outliers like the Turigniac deposit at Meliadine and Nunavut. You know, it had a 20 GT intersect on the first program and something like 6,000 or 7,000 meters. So obviously it's a rule of thumb, but there is some kind of linear correlation.
Okay.
So this is kind of a little bit of an aside, but I think interesting as well. It's the number of exploration campaigns that led up to the discovery, and so this includes surface work as well. And so the median number of campaigns it takes to make a discovery is 3 campaigns. And so kind of a storyline of how this would go would be a company goes out one summer, they do geochemistry, fly some geophysics. The next summer they go out and do some prospecting and infill on the geophysics. And then the third summer they go out and drill the targets. And so
And and so
that's
by summer 3 or 4, if they're not starting to find something, then maybe it's time to move on.
Yeah, that's kind of the point of the slide, and to be safe, let's say that a company goes out and they've done 4 passes of exploration and haven't made a discovery. I think at that point it's like either the company is ineffective or the deposit might not be there.
Because you don't have a single one on here that hits 6, interestingly.
Yeah, and the only one that hit 5 is Meliadine, which is in Nunavut in the Arctic. And the work season in the Arctic is about 2 months out of the year for
Right.
greenfields exploration. So, in general, everything takes longer in the Arctic.
Yeah, fair enough.
So this is a case study of looking at all of the initial drilling into the David Bell portion of the Hemlo deposit. And this is interesting because it goes against all of the metrics that we've been talking about. And it's here to kind of show that these are rule of thumb, and you have to kind of look at this with a critical eye and look at the geology as well. And so the David Bell part of the Hemlo deposit was discovered by Corona Resources in 1981, and this was the first part of the Hemlo deposit that was discovered. Out of 132 holes, the median was a 21 GT intersect. And so you can see a lot of this drilling was really kind of subpar, not super exciting. But I think the most important thing here was that there's anomalous gold in pretty much all of the drill holes. And when you go back and read these drill logs as a geologist, I think it would be hard to turn away from this project. I think for investors, it wasn't hitting huge intersects and putting so many drill holes into this thing. But when you read the drill logs, it looks really incredible. It looks like it's a huge alteration system with tons of sulfidation and mineralization, but they were just kind of they were just off of the main part of it.
Francis, do you have an understanding of this deposit, and like, is there something unique about it? Why they weren't hitting higher GT numbers? Did they hit them further down the road, or was it the peculiar makeup of this that they never materialized?
Yeah, so I think it was Golden Scepter who drilled the Golden Giant part of it, which was I think 500 meters or a kilometer to the northwest of where this drilling was. their initial intersects were, 200 GT, 300 GT. So the David Bell portion, they were drilling, when they started drilling deeper, that's when they really started tagging into it. And so Hemlo's still kind of a bit of an enigma. In terms, it's not a classic orogenic gold deposit or a quartz carbonate vein hosted deposit. And so it has a bit of a different geometry than a typical greenstone belt quartz carbonate vein hosted deposit.
Okay.
So this is kind of looking at the drilling and the drill results that Kenorland put out a couple weeks ago, and placing it in context of all of these GT intersects of all these 2 million ounce deposits. And so this is our Renault discovery. This is a joint venture with Sumitomo Metal Mining. We intersected 29 meters at 8.5 grams, or a 247 GT intersect on the first program. And so this was a completely greenfields discovery. There's no mineral occurrences, there's no outcrop, and there's no historic drilling. Totally undercover. And so comparable GT intersects on initial programs are something like Coffee, which was a 285 GT intersect, or Canadian Malarctic, which was a 235 GT intersect.
And I think it's worth mentioning or worth discussing. What did Goldcorp purchase Coffee for?
I think it was $520 million. And
520.
then, yeah, so Malarctic, that was discovered by Osisko Mining, the first rendition of Osisko, and there was a hostile takeover by Goldcorp, or a bid by Goldcorp, and then Agnico and Yamana came in. And I can't remember the price, but it was definitely over $1 billion.
Okay. So, this is a bit of an aside, but I think it's worth discussing. You say you went in there were no historic drill holes, there was no mineral occurrences. This was basically a blind hole you guys sunk down with Sumitomo and came back with these hits. How did you know to drill there? Why did you choose this particular target? How did you know how to position the drill holes and what angle you were drilling at? What guided this attempt? Because it's obviously not just sheer luck.
No, and I think I'll start out with that of sending people to our website, kenorlandminerals.com, and there's a lot more information there, but I'll talk through it a little bit as well. So we started out doing systematic geochemistry
Mm-hmm.
of sampling the glacial till, and we were talking about this a little bit before. I'll try and not get too technical, but a lot of Canada was covered by glaciers in the last ice age, and so up until about 20,000 years ago. And so when those glaciers kind of grew and covered the landscape, they basically bulldozed material as they covered the landscape. And so a mineral deposit that's sitting there in the rock, it basically got bulldozed and smeared across the landscape. And so that's what glacial till is. And so we went out and sampled glacial till and came up with some good results in this area, and we infilled with more glacial till sampling, and it got better and better and better, and
So
started
when you
prospecting.
infill, that means you're taking the samples on smaller and smaller grids, right? And narrowing
Yeah,
in.
exactly, yeah. And so the infill soil sampling looked really good, and we started prospecting and finding boulders up to 400 grams per ton, 400 grams per ton gold. And so from those boulders, we knew the style of the mineralization. We knew that, okay, this boulder is quartz veins, and it's hosted within a diorite, an intrusive rock. And so we did some geophysics and started looking for signatures that could satisfy that certain style of mineralization and rock type. And, I think one of the key parts of this is we put enough drilling into the initial drill program. So we put 6,000 meters into the initial drill program. And I think that's probably the mistake of a lot of companies, is not drilling enough. And, obviously that's it's having the benefit of having enough money to put 6,000 meters in is obviously a big part of it. But I think in terms of actually finding something, when you're just getting into an area, you really have to drill enough to understand if there's something there.
So, you talked about the glaciation sort of dragging, smearing these deposits over here. So were you sort of seeing the indicators in soils, say over here, and then like, did you use geophysics to then say, okay, well, we know there's gold in this area, but the target's over here based on the geophysics, and then this is where you drilled? Or did you also kind of walk up over here, do soil sampling over the top of that, see that there was more intense signature? Am I getting this right at all, or is that a good
Yeah,
description
no,
of the process?
basically. Yeah, I mean, so just if I can do it with my fist and explain. So this is the deposit, my fist. You push everything this way. So we're taking soil samples, kind of, we keep going along until,
And they're getting stronger when they get over top of they're
stronger
getting
and
higher
stronger.
concentrations. Yeah.
Yeah, and then you get up, up ice of where the stuff was pushed from, and there's no gold there. So it's like, okay, the deposit's probably
Right.
somewhere around there. Yeah.
And so what kind of grades are you getting here? Because these are not sort of sexy results that that a lot of investors would be used to looking for, right? These are sort of little micro grades, parts per billion. Is that right?
Yeah, because the kind of the volume of a mineral deposit is so small compared to the volume of the rock mass around it. And so when you bulldoze this stuff across the landscape, it dilutes it with a lot of other unmineralized material. And so, for us, when we're looking at till, a 50 parts per billion anomaly in till is really significant.
Hmm. So interestingly, you said you drilled 6,000 meters here. You came out with this 29.8 meters, 0.08 meters at 8.47 grams per ton. How far was it into that 6,000 meters that you started hitting?
That's a good question. So it was hole number 7, and so it was about halfway through that 6,000 meters.
So you're getting close to that 4,000 mark there, where
Yeah,
statistically you should be finding something serious.
yeah, exactly. Yeah. So I mean, that's kind of, we planned this program after doing this study, and it's like, okay, let's kind of use this knowledge that we've built up, and let's drill way over the median. Let's drill 50% above, and let's put a significant amount of meters, and we'll test all of the kind of conceptual targets that we have. And if we don't hit something, at least we've gone through all these discoveries, and we know that we should have hit something by that point.
Hmm. Okay, good. What's next?
So I think one question that people will ask is, okay, that's great, but how many false positives are there? How many drill intersects are there out there
Right.
that you hit these metrics, so greater than 10 meters, greater than 134 GT? How many are there out there that aren't significant deposits? And so that's kind of a difficult question to answer, because the data sources in Canada are so different. But we've been operating in Quebec, and we have some derivatives of the provincial database. And so we have all of the GT intersects of 156,000 drill holes in Quebec. And so we can look at Quebec as a case study, and look at these kind of metrics and see what pops out. And so these drill holes are from assessment reports. And so for people who aren't familiar with this, whenever an exploration company does work in Canada, they have to file an assessment report, which records it's a report of the work that they've done in the area. And so these assessment reports are typically filed during the early days of exploration. And once a discovery is made, companies usually have significant work credits, and they don't have to file reports anymore. And so they stop filing work after that.
And what's a work
So
credit? That means they've spent enough money on this project that they own it, or they effectively own the ability to explore it without reporting for a certain amount of time. What is a work credit for people not familiar with that?
yeah, so generally in Canada, the way it works is, if you have a mineral claim, you have to spend a certain amount of money on it in a certain period of time to keep it in good standing.
Hmm.
And so in Quebec, you have to spend $1,200 per claim. But let's say you spend $1 million per claim, so you can keep drawing down on that $1 million. And so, once a discovery has been made and you're putting kind of 50,000 meters of drilling into it,
$1,200 a claim per year. Is that right?
in Quebec, it's 2 years.
For 2 years. Okay. So that
Yeah,
$1 million that lasts many years, for example, and keeps your claim in good
exactly.
standing. Yeah.
Yeah. And so, after you've put in a 50,000 meter drill program, you've got millions of dollars of credits. And so, why would you keep reporting after that? So
Right.
usually companies stop reporting.
So
But
this
so,
information is heavily geared towards the early stages of an exploration program.
yeah, exactly. That's the key here. And so if we look at the entire Quebec drill hole database, we're really seeing the early stage results of those of that drilling on significant deposits. So when we plot that up and we use the GT intersect cutoff and the intersect thickness cutoff, so what we talked about before, 134 GT and greater than 10 meters of mineralized rock, out of those 156,000 drill holes, there's only 217 holes in Quebec that have returned intersects that meet those metrics. And so just to put in perspective of our Renault drilling at our Frotet project, we are in some of the top tier of the initial drill holes in Quebec.
So how many of those went on to become mines or major deposit discoveries?
So this next slide looks at that.
Ah, there we go.
And out of the 217, 66% are associated with major deposits, and the other 33% aren't associated with major deposits. But as an example of one of those areas that's not a major deposit, the Fenelon deposit falls into that. And so some of the initial drilling at Fenelon was returning 16 meters at 14 grams. And so for people not familiar with Fenelon, it was an old mine that produced a little bit of gold. Balmoral Resources held it for a long time, and Walbridge Mining picked it up a couple years ago for it was really cheap. I can't remember the exact number, but it was $2 or $3 million, I think. And so they went in and started drilling it, and Walbridge's market cap has gone up something like $200 or $300 million. And so
Hmm.
I think, when you use these metrics, you can really kind of start to pick things out. And so there's 10 deposits that are on here that are significant in Quebec that are in colors. And you can see the GT intersects colored by deposit. There's a number of deposits that are in the dark blue color that are termed as other. And so these are ones that they're not significant deposits yet. And I think things that fall in this top right quadrant are really good candidates for acquisitions, or candidates to
Right.
actually hold a significant deposit.
So that 33% of those that there is no known deposit on, that doesn't mean there won't be if they receive the attention that they may deserve in terms of drilling.
Yeah, exactly. And so a really good example of that is the Windfall deposit. And so Windfall was discovered in, I think it was the early 2000s. And so the initial drilling into Windfall was 76 meters at about 2 grams per ton. So it was over 150 GT. And Windfall sat there for a long time. It was picked up by, I think it was Eagle Hill. I can't remember the name, but it was picked up by another company, and then Osisko consolidated the whole camp. And Osisko then put over 1 million meters of drilling into it. And after that, Windfall has turned into a prospect that had some good initial drilling into a 5 million ounce deposit.
So will
So
you be publishing the list of those deposits that fall into this category but are not known deposits yet, or those targets rather?
No, you can participate on that by buying Kenorland stock. So that will be kept internal.
Fair enough.
So just to kind of bring it all home and look at some key takeaways of this. So discovery of a new gold deposit is really what drives value creation in the gold mining industry. And so looking at the initial drilling into new prospects, it can be used as a rule of thumb to get a sense of whether a discovery is significant or not, or if it has potential to grow into something else. And so the key metrics that come out of this discovery study for greater than 2 million ounce deposits in Canada is that if you're looking for a greater than 5 million ounce deposit, the median, or sorry, you should have an initial GT intersect of greater than the median of all deposits, which is 134 GT. And you should look for drill hole intersects that have greater than 10 meters of mineralized rock. For more than 2 million ounce deposit potential, the initial drill program should have a greater than 50 GT intersect, and the intersect length of mineralized rock should be more than 5 meters. And then the initial drill program meterage obviously plays a factor in this. So the median drill program on a discovery program is about 4,200 meters. And so if a company drills less than 4,000 meters and comes out with a, let's say, greater than 50 GT intersect, that could be really significant. And I think that should really be followed up with more drilling. And then if a company goes out and drills more than 10,000 meters and tests all of the geologic targets and doesn't come up with a 100 GT intersect, that likely downgrades the property or the target area. And so, as I've been saying, these are really rule of thumb concepts, and there's always exceptions to the rule. And the David Bell part of the Hemlo deposit is a really good example. And so I think it's absolutely critical that you have someone on the program that can recognize key geologic aspects of ore deposits and kind of see those initial factors that could be that smoke like you saw at the David Bell part of Hemlo.
Francis, how can this be extrapolated outside of greenstone deposits? Is this particularly specific to greenstones, or are we able to apply this or a variation of this to other gold style deposits, other gold deposits, or other
That's a
gold
really
styles of
good,
mineralization? God, there we go,
yeah.
got it out.
No, that's a really good question, and obviously this is focused towards deposits in greenstone belts. I think it really depends on the tonnage and obviously the economics of things. So if you're looking for a big porphyry system, like the intersects are crazy. Like you'll get 500 meters of a gram gold equivalent or something. And so for that deposit type, there's probably some different metrics. But so for greenstone belts, and this is probably in a way applicable to epithermal deposits as well, which are high grade deposits. So I would say that this is probably applicable to high grade gold deposits, and probably a little less applicable to huge tonnage low grade deposits.
Right. And now this is based on Canadian data, primarily Quebec and Ontario, as I understand it. But, could this be extrapolated to greenstone belts around the world, the ones in West Africa or Latin America or what have you?
Yeah, I mean, I think so. Like we're looking at about 650 million ounces of endowment in Canada, and the initial drilling into those deposits. And so, yeah, I think that they can definitely be extrapolated to other parts of the world. The geology is similar, the types of deposits are similar, and so I think these are good metrics that should hold across different jurisdictions.
Okay. And I think the last thing we want to talk about here is, what can people expect to see out of Kenorland over the coming months? I know you guys are planning an RTO. What's the timeline for that? And where can people learn more about Kenorland and what you guys are up to?
Yeah, so the next months look like we have a proposed RTO transaction with Northway Resources, which is NTW.B. And if that finalizes, we should RTO and be public within 3 to 4 months. And so Kenorland will be public in 3 to 4 months. We've got a really exciting year coming up where at our Renault discovery, which we've talked about here, Sumitomo will most likely put a large drill program into that, and so on the scale of 10 to 15,000 meters. And this isn't confirmed yet, but that's kind of what we're expecting. And so there's going to be a lot of news coming out of that. We have a project that was in Northway, the Healy project, which is a huge gold and soils anomaly in Alaska, comparable to the coffee deposit and other deposits in the Yukon. And we are going to drill that ourselves with probably 4,000 to 5,000 meters next year. So that's going to be really exciting. We have a huge till sampling program happening with Newmont right now, which is similar to what we did at the Protet project to get into this Renault area where we put out the drilling. And we're covering 3 times the area of that project. And I think that's going to get really exciting. We'll have drilling there probably late next year. And there's 2 or 3 other projects. And so if people want to know more, you should go to kenorlandminerals.com, and all this information is on our website as well.
All right. Thank you very much. And thank you very much to everyone at home listening. That was Francis MacDonald, the Executive Vice President of Exploration from Kenorland Minerals. And if you want to learn more, check out kenorlandminerals.com. And thank you very much for watching. Thanks a lot, Francis.
Thanks, Jamie. Great to talk.